the New York City Fire Pension Fund investment meeting. It is a hybrid meeting. Some folks are at One Battery Park Plaza. The others are on Zoom. Today is June 23rd, 2022. The time is 9:40 a.m. May I have a roll call of the trustees, please?
Good morning. For the mayor's office, Mayor Adams.
Sure. I'll proxy for him.
Well, you got to push.
Thank you.
Now go for it.
Shimon Ray for the mayor.
Okay, for Comptroller Brad Lander.
Allison Hirsch for Comptroller Brad Lander.
And for Commissioner of Finance, Nybach. For the UFA, Mr. Andrew Ansbro.
Bobby Eustace with Andrew Andros proxy.
Mr. Eustace.
Eustace virtually present.
Mr. Edward Brown.
Eric Bischoff with Edward Brown's proxy.
Mr. Bischoff.
Present.
Mr. Peter DeVita.
John Young with Peter DeVita's proxy.
Okay. And for the UFOA, Mr. Christopher Jensen.
Present.
Mr. William Guilfoyle.
Here.
And Mr. Paul Mannix.
Here.
And for the Fire Commissioner,
Carol Brown.
we have a quorum.
Thank you. And before
Commissioner, I would just like to say,
I just want to introduce Matthew Quigley, who will be assisting me. He's taken over for Vaughn Brown, who will be leaving the department. I think that Matt is virtual, but he will join us at the pension meeting next week in person. Thank you.
If I could, I'd also like to bring to the attention Brian Berge has joined. He's going to be joining the meeting later, but he's going to be also representing the mayor, new to the Board of Trustees, so everyone's aware, and we'll offer him our warm regards and welcomes.
So if it pleases the commissioner, the controller's office will begin the investment portion of the meeting.
Thank you so much.
All right, thank you.
And I'll probably at some point have to pop off, but wanted to start the meeting.
Thank you, Commissioner. So we have a public agenda, and then we have several items that we'll discuss in executive session today. So to begin the public agenda, which is the quarterly report, I'll turn it over to Mike Adot.
When you use this one? Sure. Hold it or
Yeah.
No, you don't have to hold it. No, just push it up.
Good morning. Good morning, everyone. As John laid out, we have a busy agenda this morning. In Q1, we're going to start with Q1 performance reporting, of which we do markets, and then we do your portfolio as well. Our risk team, Dan and Ed, are going to pop in and out with a couple presentations along the way. And then when we switch into executive, a couple things to remind you of. We're going to give you a more updated view of your returns, which, as you can guess, are not lovely. And then we're going to talk about the tactical trade in the hedge fund portfolio. And then we're doing two deep dives this morning. A lot of fixed income today. So we have Robert Fang doing public fixed income and Tina Sue doing alternative credit. So with that being said, and then we have 5 investment recommendations, us and your consultants for your consideration. So with that being said, let's just jump right in. Next slide, please. Next slide, please. So how did markets do in Q1? Ancient history, but we'll go through it anyway. You can see in the Q1 22 column, red across the board in public markets, equities and fixed income down a meaningful amount. I have some rhetoric around that, but I want to call your attention to a few different lines here. So if you first look at public U.S. equities, down in the quarter, but still up on a 1-year basis. And importantly, if you look at the far right column, the consultant expected column, and what that is an average of the 5 general consultants to the 5 different plans. And just to give you some sense of how things have deviated from expectations. And what you can see is U.S. equities, despite...
Can we move the pictures up to the top so we can see that far right line? I apologize. Thank you. Sorry.
Oh, good.
Thank you.
So you can see the expected return, annualized return is, slightly under 6, and the longer term numbers have vastly exceeded that. And we're going to come back to that a couple times when we talk about forward looking concerns in the U.S. equity market. The other number I would ask you to remember is EFI, the second line. This is what the index returned. And we're going to talk about your managers who dramatically underperformed that number, and that's the source of a lot of negative excess returns for your portfolio.
So just for my own edification, all of the prognosticators expected the far right.
Yes, the average of the 5 consultants.
Okay.
Yes.
And the reality was
The reality is the number.
line.
The realities of the other. Yeah.
Thank you.
Yeah. And the other thing you'll note is the one that's really off is U.S. equities. Everything else is kind of close. If you look at 3 and 5 year numbers in the ballpark, it's the U.S. equity market that's vastly outperformed over the last several years. And that is your biggest allocation. That has helped. Now it's hurting. And again, that's a key concern going forward. Is this going to continue or mean revert? The 2 other lines I want to, the bottom 2 lines are your credit portfolios, investment grade and high yield. Negative numbers there as well. And just a important note, the returns are both the change in interest rates as well as the change in spreads. So the negative returns there are primarily due to the change in interest rates. Spreads did not widen out during the first quarter in a meaningful way. And again, you're going to hear a lot of fixed income from Robert and Tina today. So I'm just going to stop there. Next slide, please. So what's the story behind Q1? It really was the rise of inflation and central bank rate hikes. I put up a couple key points from Q1. I'm not going to walk through them, but important to note, we've had rate hikes, not just in the U.S., but all over the world, with the exception of China and Japan. On top of the drivers of inflation, just from domestic reasons, we've also had 2 geopolitical events. And they're in the news every day, so I don't have to go over those either. Next slide, please. So I have a couple slides here just to illustrate what happened in the Q1. So these 2 slides are the 1-year forward price earnings ratio and how they've come down in Q1. So the market has corrected quite a bit on this valuation metric. And as a reminder, at the peak, which was right around year end, the valuations were historically at all-time highs, with the exception of the peak of the NASDAQ bubble. So we started from a very expensive place on historical valuations, and we're in the midst of correcting those valuations now. Next slide, please. Speaking of corrections, this slide is the unprofitable tech index. So think companies in here include Zoom, Peloton, Teladoc, a lot of these companies that traded at really crazy valuations during the pandemic. And the green line shows during the pandemic, they increased almost 4.5 times, so 460%. They've now given up almost all those gains. So that is these firms have virtually collapsed. This is a lot of the froth coming out of the bubble-esque like conditions that we had. Next slide, please. How bad was Q1 on a historical standpoint? What we're illustrating for you here, going back about 50 years, is a histogram. And along the horizontal axis is the quarterly return for a 60-40 index portfolio. So not what you have, but similar. And on the vertical axis is the frequency of those occurrences. And what you see in the black bar is Q1 was -5 point something percent. And that was in the 8th percentile of returns over the last 50 years. So really a lousy quarter for both stocks and bonds for Q1, and that has continued in Q2 as well.
What are the on the left tail, all the way, do you know what quarters those are?
I don't. I'm guessing one of them has to be 87, given the collapse in the equity market, and probably 08 is the other one, because remember, rates went up in 08 to begin with until they started doing all that QE. So that would be my guess. But
thanks.
Next slide, please. So importantly, those were markets. Now let's come into your specific portfolio. So these are the returns of your portfolio in the various public markets. And if you recall, I asked you to remember the World XUS, the index. That was, I believe, -5 point something. And you can see your managers dramatically underperformed that. So we're going to spend some time on that as well. The other thing I would just draw your attention to is the ETI line. Again, it really acts like long dated fixed income, so negative returns there as well. Next slide, please. In contrast, private markets are all showing very positive returns. So some caveats around that to begin with. The top line, hedge funds, and the bottom line, opportunistic fixed income, those are marked as of the end of Q1. But importantly, the other private markets are marked as, we mark them, they get marked with a lag, so they're marked at the end of December. And just a reminder, the carnage in the markets really started in the beginning of the year. So they have not faced those marks as of yet. These sparkling returns are not going to continue, whether they remain positive or negative. I think it really depends on what public markets do from here. So hedge funds performing as you would want that to, despite a negative year in public markets. Hedge funds had a positive year, and you can see the returns over the longer dated time. Private equity really sparkling returns across all time intervals, and they have benefited. That asset class has benefited from not only increased marks but realizations as well. Both of the real estate sectors benefiting both from mark-ups following the mark-downs during the pandemic, as well as particularly in core, the portfolio construction has been beneficial. And specifically, you have had overweights to logistics, overweights to multifamily, and importantly, underweights to residential and underweights to retail and hotels. So that construction has helped a lot.
Out of curiosity, what are you guys seeing?
What are you guys seeing for real estate with the current market? Interest rates going up. Do you see prices coming down in real estate?
Mechanically, you would expect that. And you really have to differentiate by sector because it's so different. Office in some places booming, Midtown Manhattan, not. So it kind of depends regionally as well. Amazon made a very important statement maybe a month ago about they're going to start pursuing profits and stop chasing, market share and growth. And they've been a big driver in that logistics sector and that whole last mile thing, which we've benefited dramatically from. So it's a statement that I would think make your managers kind of pause. And I would ask the managers. I think we have Blackstone today. So, infrastructure continue to do well. We'll get into a couple specifics around that later. And again, we have Tina talking about alternative credit. So we'll leave that one. Next slide, please. So importantly, how has your plan done versus the three benchmarks that we measure ourselves against? So we look at the 3-month. You're down 3.6%. You have underperformed your policy benchmark, and that is really due to the EFI equity line, which was 500 basis points behind markets. Longer term, you're close to or at your custom benchmark, so that's all good. The public and market equivalent, the third row down, you dramatically outperform that over the short term, 3-month and 1 year, and that's because of your exposure to the private markets and the stellar returns that they've had so far. When we look at the median fund TUX, as a reminder, this is 20 billion and larger pension funds, endowments, and foundations, and you've underperformed that on the 3-month and the 1 year, and that is because they have broader exposure to private markets and likely exposure to venture capital, which has just had sensational returns over the past couple of years as well. Next slide, please. So when we think about your excess returns, the middle column is the difference between your plan return and your policy index. So 40 basis points of underperformance. And we decompose that into two subcomponents, the asset allocation effect. So that was a positive 12 basis points for the quarter, and then manager selection. And that was minus 52. And as a reminder on the asset allocation, this is the slight underweights we've had to fixed income and public equities and the slight overweight to cash. So a couple basis points here helps. Let's spend some time on manager selection because that's an extraordinarily important story as well. Next slide, please. So this slide is public markets excess returns, and you can see the various time frames. When we start with U.S. equities, we see for the 1, 3, and 5 year negative excess returns, and that has been the allocation to the smart beta. So that's research affiliates and scientific beta. They helped you in the 3 month as those things have kicked in, but in longer term, they have underperformed the whole growth complex. So that's why those are negative as well. Hurting you in the 3 month number, even though it's positive, your small cap portfolio underperformed. So the negative contributors there, Cook and Dealer, minus 700 basis points or so, Wellington small cap, Wasatch, and the attribution for all of them really stock selection in consumer discretionaries, and a couple of them were underweighted relative to the index to energy and commodities. The real story on this page, to me, is row 2, your world ex-US markets. And if we had showed this a year ago, those 3 year and 5 year numbers were much bigger. They've come down. This has really been Bailey Gifford and Walter Scott. And if you remember, they're very much in that secular growth kind of stuff, that unprofitable tech index. Some of those names are in Bailey's portfolio as well. The Bailey numbers are striking, so let me share those with you. On the 3 month, Bailey underperformed by 1,700 basis points. On the 1 year, almost 3,000 basis points. Longer term numbers still positive, but it's as that growth stuff has come down, that's hurt them as well. Walter Scott, not as bad, but again, they have more quality growth rather than just the secular growth story. Core fixed income, hugging the benchmarks as you expected. ETI, as I had mentioned before, a rising rate environment. They have a longer duration than the index, so they've underperformed as well. And then you'll see the 3 month cumulative is minus 41 basis points. So that's the crux of your negative returns from manager selection. Next slide, please. So when we go into private markets, you see some really strong numbers, and we're showing private markets on a 1 year and longer basis, and we want to stick on the 1 year because not a lot changes quarter to quarter. So this is a format change that we started this year, just a reminder of that. And then again, hedge funds and opportunity fixed income through March, the other ones through December. So hedge funds, the benchmark there is kind of funky because it's the overall benchmark, which has a higher weighting to long short equity. So we expect to, when equity is down, we expect to outperform. When equities are up, we expect to underperform. But specifically in your portfolio, where did you benefit from? Your trend following systems did very well. I think Gresham and Florin Court. One of your global macro funds had just a stellar first quarter. Key Square, you had some underperformance from some of the long short equity. Altimeter, which has a lot of that growthy stuff in it, so they hurt performance. Private equity, a couple things to note here. In the 1 year number, you see the sparkling outperformance. And again, these are dollar weighted returns. So your benchmark return, the Russell 3000 was 25.5%. So this is in excess of that. If you remember, it was a 39% number. And importantly, 3/4, 75% of your AUM outperformed that benchmark. The 10-year number has underperformed, still a very strong positive number, but underperformed, and we're still being drugged down by your runoff portfolio. The returns in the runoff portfolio are literally half what the returns are in your primary managers. We are working hard on it.
Is this still a good market?
Not as good, but still good. It's become more transparent and more professional. So the bid offer spreads have come in. There's a lot of activity in it. So, and we expect, we're working on hiring a new advisor. The last one, the time ran out. So we have to hire a new advisor and go through all our contracting stuff. It is in motion, and it's looking like a fall thing that we'll get after. The outperformers in private equity include some of the names that you've seen a lot: KKR 12, Platinum 5, EQT, and the returns are they're 80%ish on a one year basis. So just outstanding. In core real estate, I had mentioned we benefit from portfolio construction. So in there, think the logistics managers that you have, a couple of the Exeter funds have done just phenomenally well. Again, sparkling numbers in the 90, 100% on a 1 year basis. Prologis has been very strong there as well. And then in your non-core, again, sparkling numbers, and you've benefited there again from some of the logistics managers. Again, some of the Exeter funds are also non-core, and again, sparkling returns. KKR, REP2, sparkling returns. Blackstone, who you're going to hear from today, 1 year returns of 60%. So just fantastic. And I'm going to skip over opportunistic fixed income as Tina's going to go into that. Next slide, please. So importantly, rebalancing, what happened in the first quarter, relatively small numbers. And most of this activity was done to fund your mid-cap managers whose contracts were finally approved. The one flow in early January was out of large cap equities into cash. You see that 50 million. That was 50 million that came out of equities into cash. And that was in the beginning of the year when the equity market was still high. But that was the last rebalancing trade we did on behalf given portfolio moves. Next slide, please. So your underweights, overweights. Again, we lay this out to see how they've changed over the past few quarters. As you can see at the end of Q1, your cash levels went up a little bit. The next three lines are core fixed income. They remain relatively the same as they have for the past several quarters. The equity line is where things have changed. So you can see U.S. equities went from being overweight to being at target, and developed in developed and emerging markets have gone underweight. And just an important note, as I said in the rebalancing activity, one small trade on your behalf to reduce the overweight. The rest of them have come down because of movements in markets, not because of anything that we have done or not done for you. I think, next slide, I think that might finish my, yes. Let me pause for any questions or comments before I turn it over to Dan, who's going to walk through some risk metrics around the portfolio.
Yeah, I just wanted to introduce myself, Brian Berge from Opie. I decided to introduce myself by screwing up a calendar this morning. I thought that would get some attention.
Great first.
Look forward to working with y'all. Probably good that I'm not there in person because the way this morning is going, I would have tripped over my feet and spilled your coffee or something.
Good morning, Brian. Let me turn it over to Dan to walk through some risk metrics on Q1.
Great. Thanks, Mike. And good morning, everyone. Brian, nice to meet you. Familiar slide for you, of course. Pardon me. I'm here with our new Chief Risk Officer, Ed Berman. Just going to review with you some highlights from the quarterly reports that you would have received and convened. Again, similar slide to what we've seen in the past, but let's run through the highlights here. If you look at the top left panel, you notice that the total plan risk for the quarter ended March 31st was 10.91%. That's up from 10.41% in December. The benchmark risk is 11.23% in March, up from 10.54% in December. The benchmark risk increased a little more than the portfolio risk, and we see small corresponding changes in your active risk and your beta this quarter. If you move down to the bottom panel there, we're plotting the ex-ante portfolio risk, the benchmark risk, and the beta for each of the last 12 months ending in March there. You notice here that the projected portfolio and benchmark risk, those red and blue lines respectively, are starting to tick upward in the first quarter as market volatility increased. This is a reversal of trends that we've observed in the past since March, April 2020, as the COVID crisis kind of took hold of markets. The chart at the top right breaks down the change in risk during the quarter into three broad categories. There's the change in volatility, the change in correlations, and the change in portfolio exposures. The change in volatility and the change in correlations categories are market-driven phenomena, meaning that these risks changed in step with market risks and were not the result of specific position weights or tilts in the portfolio. The change in portfolio exposures represents the portion of the portfolio risk that was attached from these market trends. You can see that most of the change in risk this quarter is attributed to increased market volatility rather than changes in our portfolio-specific factor exposures. And those portfolio-specific factor exposures, the bottom line, was a little more prevalent in quarters past, but you can see it's sort of moderating this time around. Finally, the table at the top center shows you the differences between your portfolio allocation by assets and your allocation to risk. As in quarters past, you'll notice that we've allocated about 2/3 of our assets to equities. The standalone risk coming from the equity portion of the portfolio is 16.47%. You see that sort of in the center there. And the standalone risk coming from fixed income investments is 3.59%. If we think about how those two asset classes contribute to overall risk, on a contributory basis, we see that 10.37% of the total risk, or 95% of the total risk, comes from equities, and the remainder comes from fixed income. We can elaborate on that theme a little bit in the next slide. Thanks. Here we're summarizing the portfolio allocations, performance, and risk by strategy for the quarter ended in March. If we look at the leftmost section, you see a snapshot of your parking place adjusted allocations on March 31st. Again, at that time, similar to a slide Mike had a few minutes ago, we had slight overweights to cash and we're underweight our core fixed income strategies. The performance section in the center there shows you a 1-year return by strategy relative to their benchmarks. And here we see the alternatives outperforming their benchmarks and the underperform that Mike highlighted for developed markets equities. And then next, we're decomposing the risk by strategy in the rightmost section. The first three columns in that section show you the portfolio risk, the benchmark risk, and the contribution to portfolio risk for each strategy. As you recall from the last slide, 95% of the overall risk comes from your equities, and here you can see how the individual equity strategies contribute to that overall total. And then finally, in the rightmost column, we're showing you the active risk or tracking error for each strategy. Active risk is an indication of how closely the portfolio follows the index to which it's benchmarked. For context, you would expect almost no active risk coming from a pure passive portfolio in this benchmark. And then you'd also expect to see something perhaps above 4% for actively managed funds. Along those lines, you'll notice that the tracking error is comparatively low for U.S. equities, where we're mostly in passive strategies, and a little bit higher in emerging markets, where we're a little more active. Finally, as in quarters past, we see most of the tracking errors picked up through our allocations to alternative investments. Again, this is partially because of how alternative asset risk is modeled in our risk system, BARA1, and partially because the performance benchmarks that we assigned as a matter of policy don't faithfully reflect the modeled risk attributes of those investments. That wraps up this section for today. I'm happy to take any questions you may have, or we can turn the conversation back over to Mike to discuss more recent trends in the portfolio.
Okay, hearing none, let's talk about some forward-looking concerns for markets. They look a lot like the backward-looking concerns, with the added concern about slowing growth. So markets now face high inflation, they face high interest rates, and now growth appears to be slowing. The geopolitical concerns still remain, unfortunately, with no obvious end to those. Next slide, please. So why are we concerned about slowing growth? It's a combination of the central bank rate hikes, quantitative tightening by the Fed just got started. Europe announced last week the end of their QE. Rate hikes are expected in Europe in the second half of the year. And the rising commodity prices, they really are starting to impact consumption. And you can see that the savings rate has come down hard, and particularly in the lower income quartile saving rates, excess savings are now back down to zero again. So when we think about this, it really, the second bullet point, this really gets into the heart of the debate in markets today: recession or recession or soft landing, which has important implications for future asset class returns. And we're going to try and frame that question in two different ways. Neutral or restrictive monetary policy. What does that mean? That means, do rates have to get high enough to be restrictive and actually slow the economy down, or is neutral enough to slow the economy down to get inflation lower? And that's critical to that recession or soft landing. Second way we're going to frame the question is to talk about financial conditions. Next slide, please. So this slide illustrates, this is consensus growth and inflation forecasts and how they've evolved over the past year. The dark blue line is GDP growth, so you can see how consensus forecasts have come down. And that light blue line is CPI and how that consensus has gone up. Bad mix for markets. Next slide, please. This is about earnings and valuations. There are two slides here. Let me try and walk through them. And the first slide on the left is about earnings expectations, and this is obviously critical to public equity markets. And the dark blue lines show consensus estimates, and the consensus estimates are still positive for the next few years. And if we have a soft landing, it's reasonable to expect growth to stay positive and earnings to stay positive. Conversely, if we go into a recession, it's likely that those blue bars have to go lower than what we've had in the past. And what's illustrated historically, the light green lines are what's termed earnings recession. And in market parlance, that is, earnings have been lower than the previous high. And until they take out that high, they call it an earnings recession. And you can see we've had a lot of those over the past several decades. And again, this is critical to the equity market going forward, whether GDP growth is the single strongest contributor to earnings growth. And if GDP turns negative, which will be in a recession, these earnings are probably going to come down. The chart on the right helps you explain what's happened in Q1 with these two vectors. So the light green line is the S&P index. And as of where this is benchmarked, the end of May-ish, it was down, I can't even read it anymore, 13%-ish. And importantly, earnings growth remained positive. That's that light gray line. So earnings growth accelerated during this time period. So what happened? PE multiples came down. That's that blue line. So earnings were still positive, but PE multiples came down. And what's really on the market's mind now is the earnings component of that. And if that's the denominator, if that shrinks, the equity market has more downside. Next slide, please. Importantly, how has recession impacted equity markets in the past? This slide shows the last 12 recessions post-World War II. The average decline during these recessions has been 24%, that light blue line across, which is kind of right where we are now, plus or minus a little, I guess minus a little, maybe minus 22 or something. And again, this gets back to that important question: recession or soft landing. If it's a soft landing, the equity market's probably fairly valued. If not, if we go into recession, there's probably more downside because we're probably going to have an earnings recession as well. And important as well, these are just snapshots in time, and what contributes to negative returns being greater or less than that median is, of course, the depth of the recession, the length of the recession, and importantly, where we started from. And where we started from this time was very historically expensive markets. And I have a slide later on that. Next slide, please. So when we think about restrictive or neutral policy, we have to talk about inflation. We have 3 slides on inflation, the actual CPI slide, labor market inflation, and inflation expectations. So a couple points on CPI that we're illustrating on this slide. On the left is the contribution, the increase in inflation from the supply constrained categories. A bunch of them are listed inside that graph. And they're color coded to show you the increase on core inflation. That black line on top sums up all those numbers. And so at its peak, which was earlier this year, these supply constrained categories increased core inflation by about 150 basis points. That is starting to come down slowly now. And in this forecast, that turns negative around the end of the year and should start decreasing inflation in a meaningful way. Unfortunately, on the right-hand side is OER inflation. What is OER? Owner's equivalent rent. This is 40% of headline CPI, so it's a big component to inflation. And historically, what we're showing on the slide, OER lags home price inflation by 12 to 18 months. And we know home prices have been on a tear the past couple of years. So OER is expected to continue to be strong going forward. So it's how these two vectors work against one another, which is going to be a big part of inflation going forward. Next slide, please. The labor market is extraordinarily tight and adding to the inflationary pressures. So 2 slides to illustrate that. On the left-hand side is the Atlanta Fed Wage Index, which is a highly regarded forward-looking look at what we think wages are going to do. And you can see they're up around 6%. So wages have increased dramatically, and that's adding to the inflationary pressures. Why have wages increased? On the right-hand side, you can see job openings versus the number of folks unemployed. That's almost a 2-to-1 ratio. And you hear Chair Powell and you hear the Fed talk about this one a lot. So there's twice as many openings as there are folks unemployed. And until that switches, we expect the labor market to remain strong. Next slide, please. Inflation expectations. There's both good news and bad news in these slides. On the left-hand side, this is the New York Fed inflation expectations. The 3 different time frames are color-coded. The bad news is inflation expectations are high in the 1-year component. The good news is they're expected to come down. So inflation expectations, which are an important component of how the Fed thinks about inflation, the forward-looking ones have not become unmoored as of yet. So this is both good news and bad news. On the right-hand side is another important expectations-based one. This is University of Michigan. It's got a long history. This, again, good news, bad news. The most recent print, which was a couple of weeks ago, was 3.3%, so a little higher than it is on this bar. And this is the 5 to 10 year component. So it's still not an alarming number, 3.3, and it's lower than where we are now, but it's up a lot off of its lows, and it's up a lot relative to history. So again, more concerning than not. And when this came out, along with the CPI number 2 weeks ago, I think this is what pushed the Fed into going 75 last week instead of just 50. Next slide, please. So neutral or restrictive policy, a couple ways to try and frame this. On the left-hand side is the real funds rate. What do we mean by that? We mean CPI minus the actual funds rate as it exists. And you can see the dark line is headline CPI, the light line is core CPI. These numbers are deeply negative as of now. As a reminder, the funds rate now is, where is the funds rate? I can't remember, 1 3/8 maybe, midpoint. Yeah. We've had 75 plus, I think we've had 150 of rate hikes so far, 3 different rate hikes. So we started, so yeah, it's about 150. Yeah. But neutral, if you look back over history here, neutral is somewhere around 0. And that means the drop in inflation has to match the rise in the funds rate. And if that can happen somewhere around 3%, 3.5%, that's a neutral kind of setting. And I think that leads to a soft landing. But if inflation doesn't come down as fast as the Fed forecasts and they have to take rates into restrictive territory, that means the funds rate's got to get above inflation. That leads to the recession and the more difficult market environment. And just
What do you think politics? Microphone suggestion.
Just asking a personal side question about just the politics, right? These are all numbers and inflation, but the policy is driven by politicians. And now with November coming up and any forecast?
in theory, the Fed is an independent. They're not elected. They're appointed, and they're staggered long terms to avoid the political cycle. That being said, they are political.
That independent federal body needs $1 of stimulus. There's no energy. See, there's no denying that that's at least partially.
The Fed sets interest rates, and they do set that independently without Congress. Congress sets their mandate. The Fed has the freedom to set interest rates.
And interest rate set reactionary to where the economy is going. Try to suppress policies.
Yeah,
I can't hear any of that.
You have to be on the microphone if you want it on record. Sorry. Okay, it's fine.
But to answer the question about November, where the market consensus is historically when either Democrats or Republicans have had control of all three houses, you typically lose in the midterm. So I think the expectation is, the House goes Republican and the Senate is kind of iffy, and that the Democrats know it, and so they've really given carte blanche for the Fed to raise rates and do what they do to have to get inflation down, because it is an unpopular voting item for either side of the party, and they're willing to take the hit in 22, get rates up, slow the economy, do what you have to do, but set the market and the economy up for a positive vector into the presidential election in 24. So I think that's the political lens that. That's the consensus. That's not my opinion. That's kind of the consensus view. But importantly, on the left, that's where the spot funds rate is. The markets are forward-looking animals. So what is the market expecting? On the right-hand side, what we're showing here is June 23 Fed funds contracts. Why that contract? That's the one that the markets think the peak in the funds rate is going to happen. This slide is a few days old, so it's showing like 96.75. This contract with that bad news of 2 weeks ago of the CPI and the Michigan number traded down to like 95.50, I think, implying a funds rate of like 4.25. It's now decreased in yield, rallied up to about 96.75. So now the market's pricing, as it gets more concerned about recession, pricing in Fed hikes only about maybe 3.25, 3.5. So this has been a lot of volatility in what the market thinks is going to be the terminal funds rate. And the terminal funds rate is very important to that restrictive or neutral component that I'm trying to focus us on. So as this thing swings around, that's that neutral, restrictive, recession, soft landing thing that's flying around here, and a lot of volatility this month. Next slide, please. So the other way to think about this is financial conditions index. So the theory of financial condition index is the movement in the funds rate really doesn't do much in and of itself. It's the various channels that impact financial markets, and that financial markets reflect what's happening in the economy going forward. So the FCI model incorporates 4 different variables: the equity market, short-term and long-term interest rates, the value of the dollar, and credit spreads. And so importantly, in the takeaways from the graph on the right, which is financial, the index, up is restrictive, that slowing the economy, down is accommodative, and that boosts markets and boosts the economy. So you can see at the lows during the pandemic, financial conditions were very easy. They have tightened up meaningfully since then. So important to note is, if you can see on that graph before the big spike into the pandemic, where were we pre-pandemic? And we are above that level now. So the financial conditions are tighter now than pre-pandemic. And I think that's reasonable to expect. And the big question, is that enough to slow the economy, to slow inflation, or does it have to go higher? I think most folks think it still has to go higher. And importantly, what channel is it going to be? Is it going to be the equity market, or is it going to be interest rates? My 2 cents is, if the equity market, so what we've experienced in the past, 5 days or so, as the equity market's gone down, interest rates have stabilized and actually gone down as well. But if the equity market's going to hang in there, then the interest rates are going to do the work. So it's the yin and yang between the two of those. As if we're using FCI as our benchmark. Next slide, please. So, as I've said, valuations have come down, but how are they historically? So this slide goes back 120 years. A few different lines in here. Let me explain them. The dark blue line is the Shiller price earnings ratio. And as a reminder, this is a 10-year number, so it doesn't move really rapidly. But when you look at a long-term basis of where that price earnings ratio is over time, it's still historically expensive. The orange line is the 10-year yield. And again, it's come up a lot from its lows. But, even at 310 or wherever it is today, over the last 120 years, it's historically expensive. The blue line, the light blue shaded area, captures the two of them. So, again, on a long historical basis, markets are very expensive. And that doesn't really predict where they are going forward. It's just important to bear that in mind. And here comes the bad news. Next slide, please. So what should we all be concerned about in this room? And what this slide titles is Lost Decade of Returns. Again, 120 years, 4 different episodes. We've had 10 years of plus of basically zero returns for an index 60-40 portfolio. And importantly, every one of those examples happened after sharp rises during that time period. And you can see on the far right side of this graph, post the financial crisis, we have had an extraordinarily strong run in markets. Certainly that's been a tailwind to our results over the past, decade or so. And now as inflation is higher, rates are higher, markets have come down, but still expensive. The thing that really keeps me up at night is the potential for one of these really tough decades for returns. So let me pause there. Dan is going to walk through some stress tests around that question of recession or soft landing. But any questions before I turn it back over to the risk team? All you, Dan.
Thanks, Mike. And hello again, everyone. I guess, putting a headline on the theme that Mike was running through in the last number of slides, a lot of uncertainty in the market. We're facing a challenging environment of lower growth, higher inflation, and increased political risk. As in the past, we've developed a number of stress scenarios that you see here to try to frame the issue. This is meant, again, just to be a thought experiment that frames the direction and general magnitude of the portfolio response to these broad kind of macro inputs. Here, again, we have 3 scenarios, so starting out with a base case scenario, which we see as perhaps the most likely outcome. Here, we're assuming that the Federal Reserve is successful in guiding the economy to a gentle slowdown. Though we've seen a lot of pain already, under this scenario, we see financial conditions degrading a bit more with a further 10% decline in equity markets. We see interest rates giving back some ground and forming a slight bull steepening. And we see inflation expectations moderating and credit spreads widening a bit as the market's priced in kind of increased default expectations just due to the slowing economy. Next over, we have a negative scenario, a less likely but still significant outcome where we're assuming here the markets enter a prolonged recession. Catalysts for this scenario could include a Fed policy mistake, some significant geopolitical shock or COVID reemergence, either of which would exacerbate supply chain problems or stress commodity pricing. This could also be driven by the consumer, perhaps in response to a decline in the housing market. Here, inflation is accelerating, driven by supply constraints, which leads to a bear flattening and further negative pressure on the stock market. We also see credit spreads widen and commodities rally in this scenario. And then finally, we have a positive market scenario, which we see as an increasingly unlikely but not impossible outcome. Think here, themes would be something like a successful resolution to the Russia-Ukraine war, or perhaps a surprise fiscal stimulus coming from China, Europe, or perhaps even the U.S. Also possible that the market has a positive reaction to something like a pause in quantitative tightening. Under this scenario, inflation is receding due to the easing of supply constraints and an increase in the supply of commodities. Asset prices rally here. You see the curve steepening a bit, credit spreads tighten, and commodity prices are declining. Given these assumptions, we can take a look at the results shown on the next slide there. Thanks. Here we're showing the predicted returns for each of these scenarios for both the overall portfolio up top there and for selected strategies within the portfolio. Each scenario is represented by a different colored bar, and the resulting predicted change in value is, of course, plotted along that horizontal axis. At the total portfolio level, you can see that results change from a 7.7% increase under the positive surprise scenario to a 13.4% decline in the recession scenario. In the negative scenarios, you can see that our more defensive strategies like hedge funds, TIPS, and core fixed income tend to mitigate losses. You may also notice that international markets sell off more extremely than the U.S. as they're historically more volatile. And similarly, you see private equity showing sharper declines than the public equity classes. Again, this is a function of how private equity is modeled in Barra 1. Here we use forward-looking models which are naive to the speed of recovery from a market shock. Nor can the models also can't speak to the skill of our managers in navigating challenging market conditions or repositioning their portfolios to take advantage of new market regimes. So in a V-shaped recovery like we saw during COVID, fundamental valuation metrics never suffered much, and the portfolio response to the economic stressors was muted. As a result, private equity actually performed quite well during the COVID crisis, even though these models predicted a large drawdown like you would see given these stresses. However, to the extent that macroeconomic headwinds persist, like those that we see today, there's an increased risk that the more extreme valuation pressures predicted by these models will come to be. And that idea certainly lends to the lost decade concept that Mike shared with you a few minutes ago. I'll leave you there. I'm glad to address any questions you may have now, or we can move into executive session where Mike will take you through our preliminary returns for a few days ago, and then we can move on to deep dives from Robert and Tina from there.
So if there's no other business in public, I'd like to make a motion to enter into executive session. Chorus of ayes. Okay. So just let us know when we're okay to proceed in executive. Please call the roll, Pat.
Okay, gaveling into the UFA's VSF. For the Mayor Adams. Comptroller Lander.
John Dorsett.
For Finance, Commissioner Nybar.
Shumon Ray.
For the UFA, Mr. Robert Eustace.
Chris Viola for Bobby Eustace.
And Mr. Edward Brown.
Yeah.
We have a quorum.
So we'd like to note the receipt of the quarterly reports. Can we have a so note?
So noted, Bischoff.
Great, thank you. So with that, I'd like to make a motion that we exit the firefighters variable supplement fund to enter into the fire officers variable supplement fund. Is there a second?
Yeah, so moved, Bischoff.
Okay. No. We are now in the fire officers variable supplement fund. So please call the roll.
Roll call, Fire Officers VSF for Mayor Adams.
Shumon Ray.
Controller Lander.
John Dorsett.
Commissioner of Finance Nybach.
Shumon Ray.
And for the UFOA, Mr. Christopher Jensen.
Here.
And Mr. William Guilfoyle.
Here.
Quorum.
So I'd like to so note the receipt of the quarterly reports for the fire officers variable supplement fund.
Noted. Liam Guilfoyle.
Okay, so with that, I'd like to make a motion to adjourn to go back into the fire pension fund public session.
Second, Liam Guilfoyle.
Pat, we are back in the public session of the fire pension fund.
Yeah.
So in executive session, the board took action regarding various investment matters, all of which will be made public at a later date. So with that said, I'd like to make a motion to adjourn.
Second.